Welcome to the deep dive. Imagine a country, right, racing towards a greener future, aiming for net zero. It needs just massive investment to get there. So how do you do that? How do you manage the huge financial risks in a sector like energy, especially one that's changing so fundamentally? Well, today, that's exactly what we're diving into. Our focus is the National Stock Exchange of India, the NSE. They've made a really bold strategic move, launching new monthly electricity futures contracts. But they're not just putting these contracts out there and hoping for the best. No, they're backing them with a really detailed plan. It's called the Liquidity Enhancement Scheme, or LES. So our mission here is to give you the shortcut, basically, the inside track on understanding this really key development. We'll unpack what these new tools actually are, why now, what role they play in India's big clean energy ambitions, and how this LES scheme is meant to make it all work. You'll walk away really getting it, not just the headlines.
And just so you know, we're basing this deep dive directly on the source material, a recent NSE circular laying out all the details, plus some helpful context from an Economic Times article. Okay, so let's kick things off with the big picture. Why electricity futures? Why is the NSE, one of the world's biggest exchanges, doing this right now? What's the driver here?
It's really about strategic timing, I think. At a basic level, yeah, these contracts let people involved in the power market, buyers, sellers, traders, big industrial users manage their price risk. Hedging, basically. But you've got to connect it to the larger context. This isn't just about smoothing out daily price bumps. It's actually a critical piece for enabling India's huge climate goals.
Okay, so link that for us. How does a futures contract help climate goals?
Well, look at the numbers. India's aiming for net zero. That needs, according to Niti Aayog, something like over 250 billion US dollars every single year until 2047.
Wow, that's staggering.
It's huge. And renewables like solar and wind, they're meant to be over half the installed power capacity by 2030. So how do you attract that kind of money? Especially for projects that last decades. You need a solid, predictable market. A dynamic electricity derivatives market like these futures gives investors the tools to manage long-term price risks. That makes India, a much more attractive place for all that global climate finance. Ah, I see. So it provides the kind of long-term certainty needed for these massive green investments. And the NSE specifically, they have some history here.
They absolutely do. Actually, the NSE was the first exchange in India to set up an electricity exchange. That was Power Exchange India Limited, PXIL, way back in 2008.
Okay.
So they've got this deep understanding of both the physical side, the spot market, and the financial derivative side. That's a big advantage. And to show they're serious and really want people trading these, they're actually waiving all transaction fees on the electricity futures for the first 6 months.
That's a pretty clear signal. Come and trade.
Exactly. It's an open invitation.
Okay, that's a strong start. Now, let's get into the specifics, the nuts and bolts. When we talk about these electricity futures, symbol LAUMBL, what exactly is being traded? Right, so the product itself is called electricity futures. The symbol, as you said, YELA CMBL. They're listed for the current month, the next 3 months, and actually all 12 calendar months eventually. So you can plan quite far ahead. Trading happens Monday to Friday. The hours are quite long, 9:00 a.m., potentially up to 11:55 p.m., depending on U.S. daylight saving time. That kind of aligns with global markets, helps manage risk across time zones.
Okay, and the size? What's one contract represent?
Good question. Each contract is for a standard block of 50 megawatt hours, MWH. That's 50,000 units of electricity. It's quoted in rupees per MWH. And the minimum price change, the tick size, it's just 1 rupee per MWH. That allows for pretty fine-grained pricing.
Tiny increments.
Yeah. And for the bigger players, a single order can be up to 50 times that unit, so 2,500 milliwards.
Right, so they're catering for large trades too. Now, how do these settle? Is it physical delivery and what about managing volatility? Energy prices can jump around a lot.
No physical delivery, it's all cash settled. That simplifies things quite a bit. The final price, the due date rate, or DDR, that's where it gets interesting. It's not just one price from one place. It's a volume-weighted average price, a VWAP. And it uses the unconstrained market clearing prices from PXIL, but also other big exchanges like IEX and HPX. It's calculated across all the calendar days of the month. It's quite a complex calculation involving daily averages and volumes across exchanges. But the idea is to get a really robust price that reflects the true market-wide supply and demand, sort of stripping out local grid issues.
Okay, so a sophisticated market-wide price. What about stopping wild swings?
Yep, they've got daily price limits, DPLs, an initial limit of 6%. If that's hit, trading pauses for a 15-minute cooling-off period. Then there's an enhanced limit of another 3%, helps prevent panic selling or buying. And margins are key for financial safety. There's a minimum initial margin at least 10% or potentially higher based on the span risk calculation system. Plus, they can add extra margins if things get really volatile.
Sounds like a solid safety net. And what about market concentration? Can one big player just corner the market? Are there limits on positions?
Good point. Yes, absolutely. There are strict position limits. For a trading member, across all their clients, it's capped at 3 million mWh or 20% of the total market open interest, whichever is higher. And for individual clients, it's 300,000 mWh or 5% of the market total, again, whichever is higher. These limits are really important. They stop any single entity from getting too much control, which could distort prices or, reduce competition.
Right.
So it really raises the question. All these detailed specs, from the settlement price calc down to the position limits, how do they actually help build a fair and stable market? And the answer is, they're all designed to manage risk, boost transparency, and prevent manipulation. That's vital for building trust.
Trust and participation, yeah. Which brings us perfectly to the next piece, because it's not just the contract design. The NSE is actively trying to build that participation with this liquidity enhancement scheme, the LES. Tell us about that.
Right, the LES. It's a proactive step. It's specifically designed to, encourage active participation and really speed up the market's development. It's actually a mechanism that Sebi, the regulator, allowed for commodity derivatives back in 2018. So it's based on a framework that already exists.
Okay, so it's not totally brand new territory.
Not entirely, no. This specific LES for electricity futures kicks off on July 11th, 2025, and it's set to run for 6 months initially. At its heart, the LES involves appointing 2 dedicated market makers, let's call them MM1 and MM2, and they're chosen through competitive bidding. Now, here's what I find really fascinating, the eligibility rules for these market makers. It's not just about having, deep pockets.
What else is needed?
Well, yes, they need a decent net worth, 5 crores rupees, no serious disciplinary actions against them recently. They need to be set up for algorithmic trading in commodities. But crucially, this is the interesting part, they must show they have a real understanding or experience or even ownership related to the actual electricity sector.
What, like power plants or grids?
Exactly. Generation, transmission, distribution, power trading, even supplying equipment or EPC work, something in that value chain.
Wow.
Yeah, it ensures the people making the market aren't just sort of abstract financial players. They actually understand the underlying commodity. It helps ground the market in reality, reduces purely speculative risk, arguably.
That's a really smart requirement.
Yeah.
So once these MMs are chosen, what do they actually have to do? What are their obligations?
Okay, so their job is clear. They have to provide continuous quotes, both a buy price, bid, and a sell price, ask, two-way quotes, on all trading days. MM1's focus is the near-month contract. MM2 handles the next month out and also adds quotes for the third month out as the near month gets closer to expiring. They have minimum sizes for their quotes, too, across different price levels, ensuring there's always some volume available. Line 1 needs 3 lots, line 2 needs 4 lots, for bids and asks separately. And very importantly, they have to be present, meaning have active quotes up, for at least 85% of the trading time each month.
85%. That's a high bar. They have to be consistently there.
Absolutely. It's not just about showing up occasionally. It's about providing constant, reliable liquidity for others to trade against.
And what keeps them honest? What are the incentives? And I guess the penalties.
Right. So, besides being present, they also have to keep their spreads tight. The difference between their buy and sell price can't be too wide. There are maximum allowed spreads, like 10 rupees per MWH for the main quote line. That ensures competitive pricing. Their performance is tracked monthly against that 85% presence target, with more weight given to the near-month contract where most trading happens. And the incentives are, frankly, pretty significant. We're talking potentially 85 lakh rupees a month for MM1 and 45 lakh rupees for MM2 if they meet all the conditions.
That's serious money.
It is. It reflects the importance of their role.
Oh.
But there are teeth. If they don't meet the 85% presence, their incentive gets cut. For example, if they're present between 80% and 85%, they lose 25% of the incentive. If it drops down to 75%, they lose half. And below 70% presence, no incentive at all.
Okay, so strong carrots and strong sticks.
Exactly. And there's even a penalty, 5 lakh rupees, if a market maker just quits the scheme within the first 2 weeks without a very good reason. They want commitment.
It definitely sounds like a carefully balanced system. So for firms thinking, hey, we could be a market maker, how does that selection process work? How do they actually get picked?
It's designed to be competitive and transparent. There was a deadline, July 2nd, 2025, for interested firms to submit their bids. The two MMs are chosen based on this competitive bidding and a specific scoring model.
Scoring model, what gets points?
Two main things. First, the quantity they commit to quoting on that main near-month contract line. More lots gets more points, up to a maximum. For example, committing to 7 lots on both buy and sell gets 10 points. Second, and maybe even more critical, the tightness of the bid-ask spread they commit to. A really tight spread, like just 2 rupees, gets the maximum 10 points. A wider spread, say 10 rupees, only gets 2 points.
So they're directly incentivizing tight spreads, which benefits all traders.
Precisely. They want the MMs competing not just on volume, but significantly on price competitiveness. And if there's a tie score between bidders, they get half an hour to revise their bids. If it's still a tie after that, it comes down to a draw of lots. Simple, impartial.
That whole process really does highlight how much the NSE wants this to be a robust, genuinely competitive market from the get-go. It's not just hoping for liquidity. They're actively engineering it. Okay, so let's try and pull this all together. To recap our deep dive today, we've looked at the NSE's strategic move into monthly electricity futures. These aren't just another financial product. They're really a key tool supporting India's massive shift towards net zero energy. They help manage price risk and, crucially, attract that huge investment needed. And we've also unpacked the details of the Liquidity Enhancement Scheme, the LES. It's this really carefully built program aiming to guarantee market depth and activity right from the start, using these selected market makers with significant incentives, but also, importantly, clear obligations. So hopefully this deep dive has given you a clearer view of how financial innovation, right down to the specific market rules and incentives, is directly plugging into a nation's big push for a greener, more sustainable energy future. And that leaves us with a final thought to ponder.
As the whole world grapples with decarbonizing energy, how might the design and, hopefully, the success of India's electricity derivatives market this blend of futures contracts and active liquidity support serve as a kind of model, maybe an inspiration, for other emerging economies facing similar energy transitions?